Welcome back, everyone, to the One Setup for Life series. In this one, we're going to be covering entry techniques in part 4. So now that you understand institutional order flow from the previous video, it's time to apply that to your entries. So in the first video, you learned the model. In the second one, I taught you how to use the 9:30 opening price to know exactly what liquidity they're going to use for this model at 9:30. And in the previous one, we covered institutional order flow. I think it's important to understand institutional order flow before you even worry about entries, because like we talked about in the last one, if you're scared money, you can't hold trades, you close too early, it's because you just don't know how to read the market and the fact that it's telling you it's going to keep going, or it may be giving you insight that it's going to reverse. Then you marry the trade, dollar cost average into losing trades, and just do things that keep traders unprofitable. So now that you understand institutional order flow, what it looks like in the candles, now we're going to apply that same logic and see how we can use that to enter and get in on these price swings for the One Setup for Life. We use institutional order flow to identify where and when to enter, with tight stop losses that optimize our risk to reward. So as we're going to get into in this video, the key with risk to reward and having tight stops and good reward multiples on the risk you're taking all starts with your entries. Because if you have a good entry and you're early on the run, it's easy to get good risk to reward. Whereas if you don't know how to enter, or you don't have confidence in your entry, and then you chase price, which then causes what? A huge stop loss that's needed, or the risk to reward's terrible. So now you're not standing to make a lot compared to what you're risking. And what you want to think about from a professional standpoint is if you're going to open up risk for a trade or open up risk on a transaction, it better be worth it. It better yield you something for the risk that you're putting on. And that's where the concept of risk to reward multiples come in. And we'll get into that in greater detail in this one here. So let's look at some basic principles as to how smart money looks at the market as opposed to retail traders. As smart money, we view the market completely opposite to retail-minded traders. So we don't even consider the same things. It's good to consider their viewpoint because that's what gives us liquidity, right? The losing traders, the ones losing their ass, are the ones that transfer the money to the winners. So it is important to understand how the losing trader thinks, but in this one, we're primarily going to be focused on the smart money perspective. Here we see in this visual depiction, we have relatively equal highs. Once the market runs higher, right? So imagine what these candlesticks are looking like as they're forming live. There's equal highs here. Let's say this is the 9:30 open, and then the market shoots higher right off the open. What is your retail-minded trader thinking? Well, we have strong resistance here, a triple top. We've broke that resistance. So that means what? Buyers must be in control. They must be muscling the market higher. When in reality, the market's trading up to these buy stops for the express purpose of engaging them. Here, retail will buy, look to go long, chase the breakout, right? Because they're buying strength. They're buying resistance broken. Smart money will sell into that rally and provide the liquidity to the retail buyers. So what you have to understand is the markets are a casino. The market makers, it's their game, right? They're the house in the casino. So whenever you go to a casino and you go to place a bet, who's taking the other side of that bet? The casino. Well, when you go to the markets and there's always liquidity available and you're buying and selling, who's taking the other side of those transactions? Many times it's the market makers or the liquidity providers. So this is their house, it's their casino, and it's rigged in their favor. This is what we're using. This is how we're able to be very consistent in what we're doing because we understand how these markets are rigged. And then looking at this example here, we have a triple bottom or strong support from the retail standpoint. When the market drops below it, retail's selling that. They think it's weak, it's a breakout, it's time to go short, and then they're chasing price around because they don't know what they're doing. Smart money will look to buy here below those lows, buying from the retail sellers and providing that counterparty to them, giving them strategic discount entries. So we look at the market again completely opposed to the retail viewpoint because they have no idea what they're doing. They're chasing price around, and that is our advantage. Retail chases breakouts, buying above old highs and selling below old lows, thinking it's confirmation, and it's not. Above equal highs is the worst place to go long, but retail looks at it like this. They chase price above highs and they chase price below old lows, thinking again it's confirmation because they don't think the markets are rigged. They think it's just randomness in the market, right? And if you look at it like that, then I guess that makes sense, right? Because buyers are taking control of the market, right? Muscling it higher. That's just not the case. And you're going to see very quickly studying what we're talking about here that retail logic falls on its face 90% of the time. In reality, it's chasing price. So while they think it's confirmation, it's waiting for the breakout, they're just chasing price around because they don't know what they're doing. They're waiting for the market to do something, then they're going to react to it. That is not what we're doing at all. Smart money anticipates those runs to liquidity and enters ahead of the expansion, predicting, not reacting. So let's look at this example here. Let's say they pump it higher. Smart money will sell into this rally anticipating that this is a sucker's play here, taking it higher just to then go lower. So smart money will predict that the market's bearish on the day. And if you're bearish, you want to see what first? A move against that direction. And it's completely opposed to the retail traders, because the retail traders are going to see this run higher and think, wow, this thing's really bullish. It's going higher. Look, we just broke above some strong resistance. And look, we got support down here, even better, right? Resistance broken, support holding. That's a bullish market from the retail standpoint. However, we're looking at it within a narrative, a logic. Why would they take it higher first if it's bearish to then send it lower? And that's what we're doing as smart money traders. We are predicting, we are not reacting. The markets are rigged for smart money, and that's how we can predict it, right? So if the markets weren't rigged, it wouldn't be possible to have precision. And this is how we're able to predict these very specific things that the market will do. If they weren't, we'd have retail results, random outcomes, and confusion. That is not the case, because we understand the markets are rigged and we understand how they're going to be rigged, and we can use that to our advantage. The market transfers wealth from the uninformed to the informed. So if 90%, I think even closer to 95%, if they're losing their ass, who's making, right? Money is not created in the markets. It's simply transferred. So who's it being transferred to? Think about that for a moment. This is the market efficiency paradigm. You must think like a predator, not the prey. The market efficiency paradigm is the perspective by which we look at the market, understanding that there is an entity that controls price, the composite man, the market makers, and they are manipulating price for their benefit at the expense of losing traders, because we understand that wealth is transferred through the market. It's not created. Then they are using this to their advantage. Think like the casino, right? When you go to the casino and take bets, are the odds in your favor or in the casino's favor? Probably the casinos, and that's why they're building new locations every single year while the gamblers are losing their ass. The markets are no different. So let's get into the specifics of how we look at the market and how we look to engage it from a smart money standpoint. We look to sell after a market has rallied or is rallying. So we want to short markets that have either recently rallied or are still in the process of rallying. So this example here, we have an old high. Let's say we're bearish on this particular day. As the market's running higher, we want to sell into that rally. So let's say there's like a fair value gap here and it's running up into that, we can sell that. Or let's say there's just an old high here, it's running up into that at 930, for example. When we're bearish, we're going to look to sell that. The retail-minded trader is going to think this is confirmation, it's strength, and they're going to chase the breakout because, again, they're just chasing price around. Vice versa for buying. We look to buy after a market has dropped or is dropping. Smart money 101. We have relative equal lows here in this example. The market drops. Retail is going to short it because they think they got a bear flag here. They think their support is broken, and smart money will buy those stops here. So we're going to buy either after a market is dropping or after it is dropped, meaning let's say we drop here and then we can buy as it's rallying because we're buying as the drop just happened. So we want to see, in summary, if we're buying, we want to see a move against the bullish direction, and vice versa. If we're selling, we want to see a move against the bearish direction, meaning the market trades higher. That's how we secure optimal entries, buying low and selling high while positioning before the rest of the market reacts. So as investors, what are we trying to do? We're trying to buy low and we're trying to sell high. Well, now how the hell do you do that? This is the logic that we use here. So the way you sell high is you wait for markets to rally if you're bearish. If you're trying to buy low, you wait for markets to drop when you are bullish. And this is how smart money will position themselves. And again, we're entering before the rest of the market, the retail participants are reacting. Because when does a retail-minded trader want to short? We're going to look to short up here. The retail-minded trader is going to say, okay, well, we broke down. Now I'm going to wait for confirmation. Support, we broke it. Okay, now we're actually bearish. I'm going to go ahead and short here. And then smart money will provide the counterparty. They will go long. And this is the worst place to short below old lows, as you'll see in the examples that we're going to cover. So let's get into the three primary entry techniques for buys. I'm going to go into 3 entries for buys and then 3 entries for shorts. So the first entry is going to be the bullish order block or down closed candles when the market is bullish. So for the sake of this model, we have our 930 opening price. From there, we frame our liquidity. We have a low here, and this is the external low here. And then we have these relatively equal highs here. We want to see what the market does at 930. It drops first. That's giving us insight. We then see after the market drops, takes out this low. They run it lower once more, clear this low here. We then trade higher. This down close candle is a bullish order block. So as the market breaks down here and then trades higher, what's the model calling for here? A run to buy side here, relatively equal highs. So if the market is going to trade higher, and we've already dropped down and taken the stops here, we do not expect this low here to be taken out. So now this down close candle in our analysis becomes a bullish order block. Well, how can you trade it? There's 2 ways to trade order blocks. The primary way that I trade it is if I'm really bullish like this, as it's trading higher and leaving that order block, I'll be buying inside that range. So like I said, You buy markets that have dropped or are dropping. What does that mean? Well, you can buy as it's dropping below this low, just buy those stops there. That's a more aggressive form of entry. The other alternative to entering would be wait for the stops to be taken and then wait for a down close candle to be created, and then you can buy that as a bullish order block. And this is an example I traded, and then as the market was leaving this range, I'm buying here. Where does the stop loss go? Just below the order block. Because as we covered in institutional order flow, do you want to see down close candles violated if we're bullish? Not at all. So you see how understanding the logic gives you clarity as to what you're doing, why you're doing it, and the scared money quickly leaves when you have confidence. So I was buying here as the market leaves this bullish order block, targeting the highs here. And you can see from a risk to reward perspective, generally for this model, I'm at least looking for 2-to-1. If I can't get a 2-to-1 risk to reward gearing, many times I'll pass up on the trade. Optimally, I'm getting 3-to-1, 4-to-1, depending on just how good the market is delivering. So here we have a bullish order block. You can buy inside that range, and then that gives you the 2-to-1 risk to reward into the buy side here. The other way to trade the order block is wait for it to leave the range and come back down into it. So you see on this candle, we open, we trade higher here, leave it, and then we come back down into it here. You can buy on that retrace back into the bullish order block. So there's two primary ways to enter on the order block. If I'm really bullish, like in this example here, I'll just buy inside of it because it might not come back down into it, and I want to secure that deep discounted entry. And then here you can see the risk reward, buying the order block, stop below it, market rips into the buy stops, and you see clear bullish institutional order flow. Again, that's why I wanted to teach order flow before the entries, because once you get in, if you're just shitting bricks and you don't know how the market should behave, it's really tough to find consistency. But now that you know what the market should do, how it should behave, how it should paint, if order flow is going to remain bullish, it makes your job really easily because now you know exactly what the market should do. So for the second entry for buying, we're going to look at fair value gaps. So here we see 930. We're going to be using S&P here for this example. So for the S&P traders, got you covered as well. Sometimes I do trade ES, depending on if it's the relative strength leader or weakness leader, just depending on what we're looking at from a relative strength perspective. So looking at the 930 open here, we frame our liquidity. We have our highs, we have our lows. Where do they run first? Lower. So sell side is engaged below 930. Now we can expect reasonably a run to these highs here. So now looking at this, we're on a 30-second chart here. 930, the market drops, and look at what they leave here. So look at how conveniently they leave this high here that's just short of this one. They see one high, two high, three highs, and now a fourth. So this isn't a triple top, it's a quadruple top. They need a new chapter in the retail book now because this is such strong resistance and it's a quadruple top now, right? So you see they run it off that, and what's that building here? Buy stops. So when we're looking at 930 and we're seeing how the market's behaving and we see it dropping, we're already expecting that this is a suspect drop to rally into these buy stops here because retail is going to want to short it and they're going to have their buy stop right up here. And you can see how the market conveniently reprices right to that level for the express purpose of engaging that liquidity. You notice it doesn't just hit the high, stop, and turn around because it's actually engaging the orders there. It's not support and resistance, it's engaging the buy stop that would be above these highs. So now within this logic, we see 930 opens, we drop, we clear out sell side. Now what would be the entry technique, the fair value gap that's created on the displacement after sell side liquidity is taken. So we have sell side taken here, and then we see a strong run higher that takes out a high. This is a shift in market structure. In and of itself, the shift in market structure is not anything crazy. But if you understand context, if you understand why the market should turn here, then the market structure shift is very impactful. So we see the market drops, takes out this low here. We rally, we clear out this high here. That's a shift in market structure. And then we have this fair value gap here. So we're buying when as the market is dropping down into it. And I did trade this example as well. As the market is hitting this gap here, I'm buying at market. Because again, we want to buy markets that either have dropped or are dropping. And that is the market efficiency paradigm. Because then as the market is rallying here, we want to start thinking of what? Well, we're already long, so now we want to sell our long positions. Why would we be thinking of selling? Because what's the retail perspective? Oh, it must be time to buy. I mean, look, we're rallying, so I'm going to chase it. I'm going to buy it up here. I'm going to have a buy stop here so that if we trade above these highs, I'm buying strength on the breakout. And you can see how that works out for them. But the market is seeking the liquidity. And if you learn to look at it through this perspective, everything becomes clear to you. So fair value gap here, as it's dropping down into that, you want to buy that level there. And then trust bullish institutional order flow to carry you all the way to your targets. And you see, like clockwork, it does. So from a risk to reward gearing, we have the fair value gap here as it's dropping down into that. We're buying. Stop loss would go below here to secure that 2-to-1 risk to reward gearing. And then you can see the stop loss is below 3 key levels. We have a fair value gap here, fair value gap here, and this down close candle, which in my analysis is a bullish order block. So the stop has to be below 3 key levels for your stop placement after you take the entry. And then as you can see here, as we learned in the last video, obvious bullish order flow into the targets, exactly what you want to see. And for the last of our primary entry techniques for buys, we're going to look at the inversion fair value gap here. So we see 930 open. This is the example we just looked at where we covered the bullish order block here. But I want to show you that in these price swings, there's a lot of different ways to enter. It doesn't just have to be one or the other. You're probably going to gravitate to one, but as long as what you're looking for as a long, in terms of whether you're buying order block, an inversion fair value gap, a traditional fair value gap, a breaker, whatever level you're trading off of, as long as it has these components here behind it, they all work. As you're going to see, look, bullish order block works, makes money. Small little fair value gap here, hits it, buy it, makes money. Small little fair value gap here, hits it, buy it, you're making money. Inversion fair value gap hits it, you're banking. But what's the common theme here? Why do all these models work? Because it's in alignment with the draw liquidity, with where the market is going to draw to. So if you're struggling with entries, or entries are a sticking point for you, it's probably because you don't have confidence in your draw liquidity. Because if you understand where the market's going, the entry is the easiest part ever. But from my experience, when I first started, and many I've worked with, we just want to skip right to the entry. Right? Well, I don't want to learn all this other bullshit, man. Just get me into the market. Show me how to trade. Show me how to get in. And as you see, the entry is the easiest thing. The first thing you have to understand is where's it going and why is it going there? Then once you understand that, like I said, the entry is the easiest thing in the world. So looking at this example here, we have this inversion fair value gap here. Why is that an inversion gap? Because it's a bearish fair value gap on the price run lower. But if the market is going to run higher here, it's going to invert its role and act as an inversion fair value gap. So once we close above it here, and then we drop back down into that level, the market's going to use it as support because it's going to reverse its role. If the market's not bearish, it's bullish, it doesn't make sense for the market to hit this gap and sell off. It's going to trade to it, through it, and then it'll use it as support here. And then for stop placement on the inversion fair value gaps, you don't want to see it traded all the way down through. So you can confidently have the stop below here, because once we get above it, you never want to see it trade all the way back down through that. And then you see it hits it, stops at the midpoint, does not get into the lower half. That's exactly what you want to see for bullishness. So you can see just in this price leg here, all of those entry models formed: the bullish order block, the traditional fair value gap, and the inversion fair value gap. What's the common denominator though? Why do they make money? It's understanding that the market's going to seek the liquidity above this high here. All right, so 3 primary entry techniques for shorts. Let's get into the bearish order block. So here we have 930, buy side here, sell side here. In this example, we see the market trades higher. We have a fair value gap here. Let's say you couldn't get short on that fair value gap. I actually traded this example and I had to use the bearish order block because when I'm live, I'm teaching as well. So when I'm trading, I'm not just in my own space trading and not having to worry about anything else. I'm actually on Zoom, calling the market, explaining what it should do, how it should behave, and it's not as easy as I make it look. So one of the things that you want to keep in mind is you might not be able to get that best entry in here. So I wanted to short this fair value gap because it's stabbing up into that. But because I wasn't able to get that fill because it happened so quickly, I then had to go into my next entry model, which would be the bearish order block here. So the market rallies, hits this fair value gap. This would have been the ideal short for this example here, but then the market does what? It breaks down. And in a sell program, or when the market is bearish, up close candles will act as real resistance. And you can see it's trading up into that. You can sell short here, or as it's dropping. That's what I did. So as the market retraced, hit this gap, and then as it's breaking down, leaving this level, I'm selling inside that bearish order block. So there's 2 ways to trade it. You can sell as it's leaving that range, but you have to be selling inside the up close candles. Or the other way to trade the order block is wait for it to leave it, come back up into it, and then short it, kind of like a resistance idea, just using retail terms. So as it's going to hit it, it's going to act as real resistance, repel price lower into the lower liquidity pool. And then you can see from a risk to reward gearing perspective, if you're selling that's leaving that range, get a good entry here, stop above the high because it should not take out that up close candle as we learned in institutional order flow. And then you can hold for a 1 to 1.5, 1 to 2 risk to reward. 1 to 1.5 is usually the lowest I'll go. So if I can't get the 1 to 2 or it's like a late entry like this, I'll still take a 1 to 1.5, which would be like risking 400 to make 600 as an example. All right, so for the second entry technique for shorts, we're going to go into the fair value gap. So we see 930 open here, and then we frame our liquidity, small little swing high here, and then we have these relative equal lows here. As we can see, the market runs higher at 930, takes out the buy stops, so we can reasonably expect after this strong breakdown here, breaking market structure here, we can reasonably expect the market to run for the sell side here. We get a strong displacement lower, fair value gap here, the market trades up into it. That's your short entry, aiming for the relative equal lows, or in other words, the retail support, because they see what? The pre-market. Low, the market rallies. Wow, double bottom, strong support. We're going to trust our stop loss there. And you can see how at 930, the market guns right to that level there, and how the fair value gap trades up into it. That would be your entry, and then it repels price lower. For the stop placement on the fair value gap, you want to have it at least be above candle number 2. So for the fair value gap, it's a 3-candle pattern. Let's go back to the previous slide so you can see it. So the candle number 2 is the candle that creates the imbalance. Candle number 1 is the candle before it, and candle number 3 is the candle that closes or finishes the imbalance. So candle number 2 is always going to be the inefficiency. You always want your stop to at least at a minimum be above candle number 2, which would be above this high here. So whatever candle creates the actual imbalance for the fair value gap, you want to make sure your stop loss is above that. And you can see it retraces. Take a little bit of heat on the trade here, but nonetheless, it does not hit that stop. And then we quickly nosedive here for the relatively equal lows. All right, inversion fair value gap. So here's our 930 open. Market pumps higher first. They leave equal lows here and this low back here. So 930, the market runs higher, takes out this high here. So now we have our condition met for us to potentially look for a short setup here. So we see the market break down and we close below this inversion fair value gap. That's key. So the fact that we close below it as we trade up into it, that's your short opportunity using the inversion fair value gap. So entry would be on the low, the IFVG, and then very similar to what we just talked about from the traditional fair value gap example, the stop has to at least go above candle number 2. So for the fair value gap, we have candle 1, candle 2, candle 3, candle number 2 that creates the imbalance. Your stop loss needs to be above that, even for the inversion fair value gap as well. So as it's slamming up into that, you're short, stop loss here, gunning for the lows here and here. And again, you'd see the liquidity is engaged that's below the 930 open. And that's how you use that 930 opening price in the context of the one setup for life. So the key to strong risk to reward is in your entries. So if you want good risk to reward, if you want the risk that you're taking to be worthwhile, meaning we don't just want to open ourselves to risk all the time. Right? As professionals, as money managers, we're not just opening up risk for the sake of doing it. If we're going to open up risk, we better be able to make something that's worth putting that risk on the table, right? And this is why risk to reward is so important. Now, don't think you need crazy, 500R risk to reward. That's just ridiculous. But in terms of from a risk to reward standpoint, if you're going to put the risk on the table, it better yield you something that's worth it. Good entries are the hard ones, the ones that feel uncomfortable because you're stepping in before the move is obvious. So if you look at those examples we just looked at, you're stepping into that entry before the run is obvious to everybody else. Let's look at one of the bearish examples with equal lows. Everybody can feel comfortable being short after it's already dropped down to those lows. But as you see, the market then reverses. That's the worst place to sell short. If you are going to sell short, you want to enter early. You want to anticipate that run lower. And the good entries are the hard ones. One of the things I say constantly to the guys that manage money with me directly in our business and those that I work with is you have to be comfortable taking the hard trade. The hard trade is the trade that is not obvious in your charts yet. And the reason it's not obvious in your charts yet is because it's the good trade. So usually the uncomfortable trade is probably going to be the good one. This is our edge, right? So the edge is only present if you execute on it well. So looking at this example here with the fair value gap, if you know there's relatively equal highs here, we've already taken out stops, and your model is to buy the fair value gap here. You need to buy as it's hitting that gap. Yes, it's going to feel uncomfortable buying as it's a down close candle, but that's what separates retail from smart money, the sheep from the lions. So you want to buy as this market is dropping. This is what ends up happening to most traders. Yeah, I know I should buy the fair value gap. There's equal highs here, but I'll wait for confirmation. So I'm going to let it hit the fair value gap, let it run a little bit, and then I'm going to enter up here somewhere. And now what does that do to your risk reward? Because the risk reward on the entry here with the stop here is much tighter than chasing price, buying up here and then having some wide stop loss that then skews the risk to reward, and then you're diminishing your edge. So the key to have a sharp edge, to know how to wield it, is understanding how to get the good entry. And again, the good entry is the hard entry. You build confidence through backtesting and daily review. That's how you train your eye to trust what you see. One of the first things I do with anybody I work with is we sit down on a one-on-one call and we break down backtesting, learning how to read price action, finding a model that's simple and repeatable, building a trading plan. Because unless you have all those things in place, you're going to flounder. You're going to take years to get profitable if you're not doing the right things. And the only way you're going to get comfortable and confident taking the hard trade, as we've been talking about throughout this lecture, is you have to backtest it. Because even when I'm buying a down close candle on an order block, before that move is obvious, that's not something I just started doing in my first 6 months to a year of trading. It took me a lot of time to backtest, get desensitized to it, see the same things over and over and over again. And once you do that, then you can have the confidence to enter and take the hard trade. But if you find yourself doing what I just labeled here, because I know I'm nailing a lot of you guys there on that one, you don't take this entry, you wait for it to leave. Or let's say you're using the order block, right? Let's say you're buying this down close as it's hitting it. Well, I'll let it hit it, and then as it runs, then I'll chase it. right? That's because you just still don't have confidence in what you're doing. There's nothing wrong with that. The way you're going to build that confidence is through backtesting. And if you haven't already seen my backtesting video, because everyone has different versions of backtesting and what that means, personally, I think FX replay, going back 6 months, looking at random 1 minute candles, I think that's more of a waste of time. I think there's a more efficient way to backtest, and that is up on my YouTube channel for you guys to see. That's one of the things that allows me to shorten the learning curve for those I work with for 6 months up to a year. And in the trading industry, that is a very quick turnaround time for profitability. And one of the things that helps me do that and shorten that learning curve is having a simple system for backtesting every single trading day. Always aim for at least 2-to-1 risk to reward on every setup. As a general rule of thumb, you want to try to get a 2-to-1 risk to reward gearing, because what that'll do is it'll help you fix losers easily. It makes the risk worth it, meaning if you're going to put risk on the table, it better yield you something in proportion to that risk you're giving. And in my opinion, 2-to-1 is a very good place to start. Over time, you can be a lot more selective and just trade 3-to-1, 4-to-1. And it all depends on the market conditions and what the market is yielding at these specific times. Without doing the necessary work to trust your model, you will trade scared money. So before I close this out, I know many of you guys are in this situation, and I want to help you understand how to get to the other side, because as you're going to see, scared money is making no money. Scared money shows up in your trading through things like hesitation. You see the setup, but you freeze because you don't fully trust it yet. That example we just talked about. You know you should be buying because it's hitting that gap, but then you're waiting and chasing it. And if you're hesitating, it's because you're not backtesting every day, or you don't have a simple system for doing it, guaranteed. The other way this manifests in your trading is low confidence, right? You second guess your read and you close trades too early. So you buy where you should, you get in at the optimal levels, but then a little bit of a retracement scares you out of the trade, or it doesn't run right away and it consolidates a little bit and it scares you out of the trade because you don't have the confidence in what you're looking for. And if that's the case, you need to be putting in the reps every single day backtesting. Over confirmation. You wait for extra proof, and by the time you act, the move is gone. So if you know you should be selling as the market is rallying higher, but then you're going to wait for confirmation, I'm just going to let it hit that bearish order block and then run, then I'll go short. Then you're skewing your risk to reward, you're opening up way more risk than is necessary, and the move is gone. And either the move leaves you, or the worst thing you could do is then the move left you and then you chase it impulsively. And that's going to lead to that cycle of, I took a bad trade, I know I shouldn't have, damn it, let me fix it. And then you know how fixing it goes, then you end up blowing your whole account. And it's very easily fixed with knowing what you're doing and how to execute. Chasing entries. So you react instead of predict, turning your high risk reward setups into emotional trades. So if you're taking that hard entry early on in the price run, it's easy to let it run, because if you're getting a good entry, many times it's going to run right from your entry directly to your targets if you're on side. However, if you don't enter where you should, again, you're going to skew the risk reward and you're going to make it an emotional trade. Because what's the problem with chasing? Well, let's say, okay, in these examples we looked at, let's say we know we should buy the bearish order block, but then we wait for it to run 50 points above it, and then you buy chasing it. Then what happens? Where do you put your stop loss? You can't place one because the stop loss would have to be so wide because you've chased the market. And now you have huge risk open on the trade. You got a horrible entry, and now emotions start flooding your mind, and that's why you can't execute consistently, because these are the problems you're running into. And they're very easily fixed, but you have to understand what you're doing, and you have to follow a consistent process. Scared money makes no money. But fear is replaced with confidence when you learn what you're doing, when you understand your model, trust your process, and execute with confidence. My goal with this series is to help you guys step into profitability, and it comes with these things here. Confidence in what you're doing, understanding your model, and trusting your process. That's what professionals are doing. Consistent traders are not stressing about the next trade, the next 2 trades, the next 3 trades. They're trusting their process. And that's what then allows them to execute with confidence, because you learn eventually that it's not about the next trade. It's not about the next trading week. It's about, do you have a simple, repeatable system that you can execute every single trading day when the model forms? And if you can do that, confidence is going to replace fear. If you're trading scared money, you will not be profitable. And the way you graduate from trading scared money to being confident is understanding what you're doing and why you're doing it. And then as a side note, many times the issue with scared money is because you're just risking too much. So if you're putting on the trades and immediately you feel a sensation, if your stomach drops, you're stressed out, every fluctuation is life or death, you're probably sized too big. And from my experience of working with a lot of traders, just sizing down by half your position fixes that easily. So let's say you're trading too many contracts and you're stressed and you're shitting bricks every single time you're trading. Well, the problem is you're probably sized too big and you might not be comfortable trading that risk right now. So one of the things that you want to do is size down to leverage that is comfortable. And then once you get good, you get consistent with that lower leverage, then you'll be able to scale your trading in a sustainable way. Most traders are in a hurry to make big money and they scale in unsustainable ways that causes them to blow up. So if you want to be like the few percent, the 5% that's profitable, you have to not do what the 95% unprofitable herd is doing. And it's all the dumb shit that we've talked about here. And if you want to see examples of me using these PD arrays, picking the right ones, it's always the question, well, how do you know the right fair value gaps, the right order blocks, the right inversion fair value gaps? If you want to see me using these entry models every single week, join our free Discord where you'll see recaps of me trading live with my group every single trading week. Hope this one was insightful. See you guys on the next one.